evening, everyone, and welcome to The Money Show. I'm Arfan Dabash. Well, today it's a bit of a different show. We're not exactly taking on board all your questions and queries, but lots of interesting topics that we will be discussing. We will be talking about the global comparison of the cost of mutual funds before taxes, some interesting data points that have been delivered for the same. We'll give you an insight as to what the expense ratios are globally as well as back home, and also go on to talk about what the importance is for investing in mutual funds and how the mutual fund industry so far has shaped up. Well, for that and to guide us over the next half hour, we have Dhruv Mehta. He's the chairman of the Federation of Independent Financial Advisors with us in our studios. Good evening, Mr. Mehta, and thank you so much for joining in. So let's just talk a little bit about the rationale for delving so deep into this. You know, these studies are talking about the annual expense ratios essentially of mutual funds. So you've spoken about countries across the globe and it's been really looked at as a comparison as to where India stacks up as well in comparison. Yes. So give us a sense as to what have been some of the key findings.
Thank you for having me on the show. I think one of the key findings of this study is that when we compared across 25 countries across the globe, interestingly, we find that India is one of the most cost-efficient industry that we have. We found there is a common perception or myth that Indian equity funds are very expensive. But when you do a global comparison and you compare costs which are comparable on a like-to-like basis, we found that Indian equity funds are amongst the third least expensive in the globe, and which is very encouraging because of the size of the industry that we have. We are not a very big size in terms of AUM globally across the world. India might be the 9th or the 10th country, but in spite of that, I think Indian mutual funds charge very reasonable, I think, especially if you see the overall cost, because what happens is a mutual fund is not just about equities. Mutual funds provide products across a wide range. You have very safe liquid funds, you have other debt products, and then you have equity products. All put together, the mutual fund industry as a whole receives about less than 1%, after if you were to adjust for the taxes which are paid. So I think when the industry is getting 1% and overall, all investors, when they are served, at a cost which is a combination, because an investor invests money in both equity as well as debt. And the overall cost of 1% is, I think, very reasonable for the sort of value add that the customer gets. I mean, you compare the cost that the banking industry charges a customer, or a non-banking finance, all of them work on a margin of 2 to 3%. And in that context, I think the Indian mutual fund industry, in terms of the service that they render and the returns that they have delivered. In fact, a recent publication of the CRISIL fact book, it shows that mutual funds for all categories, equity funds, debt funds, they have outperformed the benchmark indices after expenses. So I think that if you look in terms of what returns that the customer is getting after paying for expenses, it is a really tremendous job that the industry has done. And I think that the trend that we are seeing in terms of the proof in the pudding, I would say, is that investors are now accepting this as a very, they are accepting this as a product, as something which meets their need for, savings, long-term savings. And we are seeing a tremendous growth of flow into mutual funds from the individual investors. The percentage of the individual investors' AUM is rising.
Right. I want to chat about all of that and even the growth of the mutual fund industry as a whole. But let's talk about the explanation for the bundled fee arrangement and the unbundled fee arrangement. Yeah. Can you just explain to our viewers what they mean, which countries they're traditionally used at, and what is more favorable for India?
So in the Indian context, what we have is a bundled arrangement. That is a structure in which the mutual fund fees includes the fund management fee as well as the commission or the fee that is paid to a distributor or advisor. It is all part of one cost which the mutual fund charges. And India, Canada, France and Germany, China, these are the countries which have a bundled arrangement. And there are, in the study that we have done, out of 25 countries, there are about 8 countries which have an unbundled arrangement. That is that the investor pays the asset management company the fund management fees, and he separately pays for fees to an advisor. So obviously the cost that the mutual fund charges over there is much lower. The countries which are predominantly on a bundled arrangement or an unbundled arrangement are countries like USA, UK, Australia, Netherlands, and Switzerland, Sweden. So there are 8 countries which are in this structure where the fund management charges a particular fee and the investors separately pay the advisor for the fees and platform charges. So if we have to compare the cost that an investor incurs in these two sort of separate structures, we need to adjust so that the costs are comparable. And that's what this study attempts to do, is that all the 25 countries, we try to see that they can be compared on a like-to-like cost basis.
Just to take off, yesterday we had the AMFI Summit 2018 and some comments were made by the chairman, Ajay Tyagi. He said that individuals should be encouraged to invest directly if they can manage it on their own. And he was talking about a strong case for direct plans, that AMFI should promote them to check mis-selling in mutual funds. I just wanted to get in your thoughts on that and how you're reading into what investors should do, would it be disastrous to leave investors on their own in a developing nation like India, because there's two sides of the story? Or do you think that, as Mr. Tyagi said, there is a need to do so?
I would say that the common retail investor needs an advisor, somebody to take him along. I think world over, the experience shows that a lot of time investors are their own enemies. It is your own behavior in terms of fear and greed, which, actually hinders the long-term investment performance. And therefore, just as, for your own personal health, you would, go to a doctor or somebody to take advice as to, what is needed for a good health. I think an individual investor needs somebody to guide him as to what he needs to save for. There is a identification of the need for saving, and how you should achieve that goal, and what are the the products come last. What are the products which make up a solution, so that it will meet the investor's need. And I think there are so many things, like a simple, I would say, that driving a car, one can drive the car on one's own, one can learn. And even if you have learned to drive, many times you would decide to either take a Uber or a taxi or hire a driver, so that you are doing your work, but you outsource that activity. So I think similarly, when there is a problem with a car, do you always rectify it yourself? No. Many times you would, get it repaired by a professional or by an expert. So I think investing is also a subject which requires a lot of expertise. Investing requires a study of, the historical returns of different asset classes over long periods of time. And investing is also about having discipline and patience, which many times is what an advisor brings in.
If I could just come to you and, forgive me for taking references from Mr. Ajay Tyagi. I only do so because the event was yesterday and there were a lot of interesting points brought up by him. He's also talking about, tremendous growth that we've witnessed in the mutual fund industry. And that, of course, is no doubt that we have seen. But he says that the market share remains very concentrated to a few big players, that the top 4 mutual funds account for almost 50% of the industry's assets under management, while the top 7 account for 70% of the industry AUM. That's on the front page of the Economic Times as well. Is this worrying? Why are we seeing this sort of a trend? I just want to understand your thoughts.
I think in any market economics, I think what does happen is, typically we have the rule of three. The top three players generally will account for a large market share in any industry, because those are the people, who have been very successful, who have somehow found it, that they can deliver performance, service, everything that a customer needs, maybe in a little better way than the others. And maybe there are a lot of new entrants who have entered recently, obviously need that time in the market to establish themselves and therefore get a larger share of the AUM. So I would per se say that concentration per se is not a risk, because today I think you have the large players who are having a larger share of AUM. You will see historically they have done well across all parameters in terms of performance, in terms of service. So I think SEBI regulations does allow new players to come in, and maybe the better way is to allow ease of entry of new players into the market. So as more and more new players come in, there will be greater competition, and maybe that would lead to lesser concentration.
Stay with us. On that note, let's slip into a quick break. Coming up on the other side, we talk a lot more about the importance of investing in the mutual fund industry, the kind of growth that we've witnessed, as well as a whole host of new fund offers that are on the anvil. Dhruv Mehta is with us. We'll come right back. Great to have you back with us. Thanks so much for staying on. This is The Money Show. We're in conversation today with Dhruv Mehta, the chairman of Federation of Independent Financial Advisors. Just to talk about another topic, there are a lot of NFOs now that are upcoming, and a lot of investors tend to subscribe to them because the net asset value is priced, I think, a little bit cheaper than what an existing mutual fund is. But what exactly is your view on whether or not it makes sense for investors to invest in NFOs?
So I think there is no one answer. One must look for, each investor should look at his investment horizon and look at the plan. Generally, an existing fund or an existing mutual fund would have an established track record, and therefore it is easier to make a decision, as to which fund to invest in. But a lot of times you have products with a particular time period, So like closed-ended funds, if you're really wanting to invest for 3 years, then you have a lot of these fixed maturity plans coming up where you invest the money with a particular fixed horizon in time. So I would say there is no one answer. One has to see, each investor has to see what his need is and typically whether the product is suitable for him. I think, so I would say there is no one answer, and typically investors would have to individually see their needs. So as you are showing, there could be a fixed maturity plan. So if you need money after a fixed period, you're very sure that I need money after 3 years or 5 years, then that becomes ideal that you put money into a fixed maturity plan.
Okay. So there's no fixed answer, but it depends on one's financial needs. Of course. That's right. Well, I'm sure you'll appreciate that the Times Network and the Association of Mutual Funds in India, that's AMFI, we've recently launched Jan Nivesh, that's an investor education initiative. We're getting people to pledge to invest at least 1 day's income into mutual funds. This is for their long-term benefits. And I'm going to tell people how they too can be a part of it. But, we've had many on-ground initiatives and lots of investors who have taken part, and we have some questions as well from those on-ground initiatives that I would like to take on board with you. First up, can you just give us your thoughts on what you've made of this initiative and really the importance, Mr. Mehta, of investing in mutual funds, why you think going the SIP route or the mutual fund route, even in today's times of market volatility, is one of the safest modes of investment?
So I think very simply put, systematically savings money, I think is so important, is so very important for, the purposes could be diverse. It could be for somebody's retirement. It could be for daughter or son's marriage, it could be for education. These are all long-term goals. And to meet these long-term goals, to invest or save money systematically is very important. And therefore, I think mutual funds as a vehicle is so structured, so well regulated, and it has, in the Indian context, if you see the performance that mutual funds have delivered, the convenience that they offer, I think it's a wonder, you know, that I think the movement has just taken off in the last 2-3 years. It has been supported by an ad campaign, so there is a greater awareness. So I think this whole movement of saving money, and for somebody to have a vehicle which is well regulated and which can deliver returns, which can ensure that, you know, you meet your goals. So I think I can just say that the systematic investment is just, you know, bringing discipline, and with the discipline and following that discipline of saving money, I think long term, you know, the compounding works, and I'm sure that most investors would be surprised at the end of 10-20 years as to the amount of their, you know, how the savings have grown just by sheer compounding.
Okay, that is the view on, investing and how important it is to put your money in mutual funds. In fact, from our on-ground events, we've got questions. We've had Mr. Bhojwani who has sent us this question at our on-ground event. If that could just come up on the screens, it says, when I go to see a website, I see more than thousands of SIPs. How do I understand which will be the best scheme for me to start? And I think, Mr. Mehta, this is going to, be a connection to the question that we asked on NFOs. It is also linked to your goals, I'm sure, your time horizon, what you have in mind, etc., right?
Yes. So
what's the advice for Mr. Bhojwani?
So there are, I think first is an investor has to really decide that whether he wants to do it on his own or whether he wants to use an advisor. It's like, when you want to take care of your health, long-term health, one can do it on one's own, or one goes to a doctor or to a physician to take advice. So I think first is a decision that one must make, that whether I'm going to do on my own. Investing is not very complicated. It can be done by an individual on his own, but he has to spend time, energy, and he has to understand and then do in a very disciplined manner the investing. The second is to use an advisor who will guide him, who has the expertise about the products and the markets and what is the process that is required. So I think fundamentally this is the first thing, is that a leap of faith is whether you do it on your own or whether you use an advisor. After having done that, I think discipline is very important, that one follows this discipline. One should have a long-term orientation, because in the short run the markets can be very volatile. And I think if one is this investing, actually, if you look that if you want to earn average returns, actually it's a very simple game. It's very simple to earn the average return. You could just put in an index fund. But human nature wants to always do better. And for every 1 percentage point that you want extra, there is a tremendous amount of effort. There's a disproportionate effort actually required. Okay. And that's where I think people get, lured by greed and fear, and that's, what creates problem.
All right, that's the view coming in. And of course, do remember to all our viewers that you too can be a part and a partner of the economy, Indian economy, the growing economy, by investing in mutual funds. You can join the Jan Nivesh movement. You have to just give a missed call on 1-800-333-666, 1-800-833-666. In order to pledge to invest at least 1 day's income into mutual funds. This is an initiative by the Times Network and the Association of Mutual Funds in India. And with that, thank you so much for joining in, Mr. Mehta, on the show and telling us a lot about the mutual fund industry, the growth that we've seen so far, NFOs as well as expense ratios. It's been a pleasure having you on board.
Thank you very much.